There are imbalances with Japan, with Europe, with Australia, with India, but enemy number one is China.
Now what has happened is that the tariff announcements have been made and now central banks start selling. Basically, there is a fire and now I'm putting petrol on the fire. In a market in which everybody is selling and there is no buyer, the prices will just move in one direction. And it was very counterintuitive because everybody would have expected that the bond yields would have fallen. And the reason folks have become nervous is that a failure of the bond market is catastrophic, and that's what seems to have spooked them.
So at some point, I think China and the US will come to the negotiation table. The very fact that they are still imposing duties every other hour suggests that they are now realizing that numbers are now meaningless. Beyond a point, I think the costs of the disruption will be so bad for China that they will, through backdoor channels or whatever, come to some agreement. Bad case outcome could be that this results into some other distraction and actually not just a trade war but an actual war.
Hi, and welcome to a very interesting episode of Open Dialogue. Today's topic is the recent tariff announcements and what it holds for the world going forward. Joining me for the discussion is Neelkanth Mishra. Neelkanth, welcome to the show.
Thank you for having me.
Before we start, I just want to make some, caveats. Today is the 11th of April and
3:30 p.m.
And 3:30 p.m. So by the time this episode is telecast, yes, it's at least a week down the line, and so the world may have changed completely. But with that caveat, let's kind of start. The one episode I'll request our viewers, if they're interested in this topic, to go and see is the discussion we did on industrial policy. We did this about 6 weeks back, and it has a lot of the context and story around why industrial policy is coming into force and what it implies. But Neelkanth, just coming back to this, so over the last week or so, we've seen some fairly material announcements coming out of the US, and which seem to have made several disruptive changes. A lot has been spoken about the announcements, what their levels are, and so on and so forth. What will be great to do in this conversation is get a little bit into details and peel the onion and figure out a few things. First is what is the problem they are trying to solve, right? Where is this coming from? What is the problem that they're trying to solve? Second, how they are going about it and what their core beliefs are. And third, then we can also look at implications both for the US, for India, for the rest of the world, etc., etc. So maybe we start with the first question, which is what's happening? What is the problem that they're trying to solve, and how have we landed here?
So that's I think a great place to start, because it seems that they themselves are not very clear about what they are doing, and there is a lot of inconsistency in some of their policies themselves. So they want a weaker dollar. They're raising tariffs which actually will strengthen the dollar. They want to corner China, but they seem to be very eager to upset all their allies as well. So the question is, what is the underlying objective? So I think what you can make out from the collective announcements and some of the newspaper reports is that it's a primarily political problem. So when people say that this is an economic issue, of course it is an economic issue, but that the economic tools being used are not very sophisticated and perhaps actually the wrong tools to use, which may or may not be right, but the point I'm making is that it is first and foremost a political problem. So I think the Trump administration realizes that the current system was not working.
Right.
And they want to replace it with something. Because of the complexity of the problem, I don't think they're very clear on what the new system is likely to be. So they will make it as it goes. And which is why you see tariff today, no tariff tomorrow, something else the third day. What are those political problems? I think the first political problem is that inequality in the US is very high. In the last 35 years, median real wages in the US have not changed. And I heard this shocking statistic that the gap in life expectancy of white males, so A and B are both white males. A is a graduate, B is not a graduate. The gap is now 17 years. So that shows that there's been significant disparity. And some of the comments that have come from Treasury Secretary Bessent, for example, that the stock markets have done very well. And a large part of the gains in the last 35 years have actually gone to capital owners, and which is the stock market. And 88% of stocks in the US are owned by the top 10%, and the bottom 50% own no stocks at all. And in fact, there have been studies, he doesn't quote them, but there are separate studies which show that of the total market returns between 99 and 2016, only about 15% came from economic growth. 40% came from the shift of incomes from labor to capital. So labor share of capital has gone down, capital share of income has gone up. So these are very deep-rooted political problems. This is one issue. I think the second big issue is that the current international financial system, because it is based on the US dollar as the reserve currency, almost necessitates that the US run a current account deficit. Now, which I think is not something the Americans should really be complaining about, because this is the reason, this is a very big part of the reason that the US economy today, which was the same size as the Europeans 15 years back, is now 50% larger. But in the process, if you have, for example, if you have a current account deficit for say 20 years or say 2% of GDP, there is a 40% of GDP deficit that you've accumulated. And so the net international investment position is now minus $18 trillion. So I'm sure, as we will discuss, this poses what is called a new Triffin Dilemma. And that at some point, the dollar's status as a safe currency is bound to be questioned. Now, it could have been done 5 years later, but there is no better time than to do it now. And while this is not being explicitly stated by the president himself so far, but parts of his team have put out these thought papers and these feelers. And there are people now openly speculating on whether the yen should be forced to appreciate by 20%. I wouldn't be surprised if, say, the Vietnamese dong is forced to appreciate, and so that the value of the dollar liabilities actually comes down. So many of these sort of global financial and economic models also need to be reset. And thirdly, I think the US in general has understood, and maybe it's a corollary of the first two, that the multilateral order is not working. So the US was the one that stitched together the multilateral order for the Second World War. But as the executive order on 2nd April very clearly states, it's not working for us, which is why they've stopped funding the World Trade Organization. And now they just want to sign bilateral treaties. It gives them much better leverage, because when they're talking to smaller economies like, say, India or Vietnam, they can get their way much better instead of all of them ganging up in a World Trade Organization. So as they think about resetting the world, they're also saying that, look, this multilateral system, because if there are one or two big bad actors, of course pointing at China, it distorts the whole system, and therefore the existing. So these are the three primary objectives. There is a severe inequality / political problem in the US, that the current system where the US debt to GDP or the international liabilities as a percentage of GDP is very high, and third, that the multilateral system isn't really working.
Very helpful, Neelkanth. Now, let's also link these two, hence the direction that they are taking. So one kind of implicit or actually even explicit kind of problem statement that they have laid out is that because US is the reserve currency, it is overvalued, and because it is overvalued, it is, kind of imports are incentivized and exports are disincentivized. And just to kind of make this clearer, if say rupee to dollar is 85 for simplicity, so let's say India manufactures something which is worth 8,500 rupees, that's $100 in the US. Now, if the dollar appreciates, which means the rupee, let's say, goes to 90, so then that is, maybe $95 or something. Whereas if the rupee, if the dollar depreciates and the rupee goes to 80, then that's 110. If hence the dollar depreciates, then imports become expensive and exports from the US become cheaper. And so because the dollar is overvalued, the belief is that manufacturing in the US is disincentivized and manufacturing has hence moved out, which also has led to the problem number one, which is the income inequality. Because had manufacturing jobs remained in the US, wages would have risen, and this the kind of the 50% population which is not capital owner, this is the kind of the working class, and their incomes would have risen.
That's correct. So a much simpler way of saying the same thing is that if you are the reserve currency of the world needs, or entities, whether it is central banks or corporations or insurance funds or pension funds or others, need to accumulate dollars to show that they are safer, or
their currency is strong, and
whatever, right? So now, in order to do that, so they have to accumulate dollar assets. So if you put it very simply, in order to get those dollars, say you are the US, I need to give you something.
Correct.
And therefore, I need to provide a good or a service to you. So in effect, the demand for safe assets and the fact that this has to be in dollars keeps the dollar artificially stronger than it would have been if it was only based on demand, supply, and investment prospects. So now, it is a very hypocritical complaint that his reserve currency status is the reason why we have problems in the US. Remember that they are an $85,000 per capita GDP economy today. When they complain about, for example, say electronics not happening in the US, point is that in electronics, and even in semiconductors, the biggest value add is in chip design, in design automation, the electronic design automation, semiconductor equipment manufacturing. Semiconductor manufacturing itself, though while it is one of the most advanced technologies developed ever by humans, does not cover its cost of capital. So a lot of the value in semiconductors actually goes to chip design firms, the software firms that help the chip design firms, the equipment companies that provide the technology to semiconductor manufacturers. So the US has actually moved up the value chain. So while the reserve currency status does indeed become a disadvantage when it comes to very low-end manufacturing, it has been a huge boost to the US's ability to tide through cycles. So so they are the only economy in the world which is above its pre-pandemic path. And as we've often discussed on our podcasts, their debt to GDP, that they are the only economy which is above the pre-pandemic path, primarily because of fiscal interventions. No other country would have been able to do what they did without the ability to be able to printing currency. And this has actually been distributed to everyone.
Correct.
So I think it's a bit disingenuous, though the fact that it doesn't sustain, and therefore we have to find a new solution. So instead of finger pointing, blaming, I think the realization that the world should have now is that the old system, which was kind of established after the Nixon Shock of 71, is no longer working again, and we need to go and get it reset again.
Sure. There was recently one, I forgot who it was, but someone said that what's really happening is that, and they were taking the US-China example, that China is manufacturing something at really low cost. They are figuring out how to reduce the cost, and they are sending it to the US. In return, the US is printing some paper and sending it to China. So it's not a bad deal at all, right? So
I know.
So just coming back now, I think we've covered a lot of ground, and just to unpeel a few and get into the depths of a few of the things you mentioned. First will be just helpful to talk about this Triffin Dilemma, and second, you also mentioned the Nixon Shock. So maybe we also go through that both the Bretton Woods and then the Nixon
Sure.
Shock.
So let's look at the international economic order and the fact that every country needs to have its own currency. So we cannot all agree to have the same currency. So everyone needs to have their own currency. Now, through history, the way to signal strength of a currency or weakness of a currency was basis the dollar holdings that the economy had. So basically, it was a gold-based exchange system. during the Great Depression, so after 29, successively countries broke the peg to gold because they wanted to. I mean, it was a very mercantilist view that you want to devalue your currency so that your exports become cheaper, as you were explaining earlier. And so in 1931-32, Japan and Britain broke the gold peg to gold. 1 or 2 years later, the US had to break that. A couple of years after that, Switzerland and France broke that. What was very interesting is that the countries that broke the peg first, like Japan, so if you plot the industrial production in Japan, it shot up first. So throughout the decade, now weaker yen may not have been the only factor, but it was definitely a contributory factor. Same with, so then Britain did the next best, and then America and France, because it was the last to break the peg, so its currency remained the strongest, saw a decline in industrial production throughout the decade. What is shocking is if when you plot the currencies against gold, is the scale of the y-axis. Currencies moved by 50 to 250% in the space of a decade.
Right.
So as you can imagine, it had become a very competitive devaluation. I let my currency fall 10%, you do that again, then I do that again, you do that again. There's no end to it. So when the Second World War ended, or around the time it was about to end, and it was reasonably clear who was winning, so there was the Bretton Woods Agreement. So at Bretton Woods in New Hampshire, the hotel, it's a beautiful hotel actually. And there are these flags in the conference room, and there's a flag of India as well as, for example. So all these countries were brought together and to discuss what would be the new monetary order. And in order to sustain that, of course, the IMF, World Bank were created. That's why they called the Bretton Woods institutions, because that was their way of clear. The system that was evolved here was that every currency, because competitive devaluations were not helping anyone, so everyone agreed that currency should be pegged to each other.
Right.
Now, remember that at that time, of all the major economies, China and India were still not independent. China was fighting its civil war at that time. Japan, Germany, Italy had just lost the war.
Correct.
France had just come out of occupation. And the UK had pretty much been a subservient state to the Americans during the Second World War. So right from the Blitz, when the Brits felt that they didn't have enough aircraft, they had been begging and pleading and relying on the Americans to supply them everything. Frankly, this started in the First World War itself.
And economically, they were in quite a bad place.
Quite a bad place, right? So, so it was pretty much America which decided. So they steamrolled through all kinds of opposition. And the world then decided to peg itself to the dollar. So every currency would be pegged to the dollar. Now, what America said is that I'll peg it to gold. So it's not that I will be irresponsible. So I'll peg it to gold. And everyone agreed on that. It took 10, 12 years for it to get fully implemented. It was a complex system. So it kind of fully came in force only in the late 50s. In the early 60s, on Triffin, he posed this Triffin Dilemma. He said that any country which is providing the reserve currency, and as we discussed, if you provide reserve currency, you have to have a current account deficit, over a period of time will have such a large cumulative deficit that it will not be able to peg itself to gold. Basically, it is another way of saying that the global monetary expansion cannot be financed by gold. Now, or even if it can be, it cannot be just one country that does it. So he said this scheme is not going to work. And therefore, it is not surprising that as the US suffered through some rounds of inflation in the 60s, and so when Nixon came to power, it was very clear that they would not be able to honor. So if someone was to demand that, okay, so these are the dollars I hold, why don't you give me gold against that? They would not have enough gold. And so there's this fascinating book, 3 Days at Camp David, where 15 people sort of fly and discuss, including people like Arthur Burns, who was a Fed governor, and Paul Volcker, who was going to be the Fed governor, but at that time was undersecretary. And so all of these people, Treasury Secretary Connolly, apparently Kissinger was not there because he was sorting out the Vietnam issues. So these 15 people decided that we are going to break the peg to gold. But because this was going to be a big monetary shock, and they also wanted to devalue the dollar. So the arguments used were almost the same as what are being used now. That we have sacrificed ourselves and that we have accumulated so much debt. I mean, the fact that they gained consumption and investment out of that was of course forgotten, but that we have done this, and therefore they said 10% import duties on the whole world, and now come and negotiate a dollar devaluation. So 4 months later, that's where the Smithsonian Accord was signed. Eventually it didn't work, but point is that there was a forced devaluation of the dollar.
And the peg to the gold was broken.
That was broken. So that was broken. That was not negotiable. But in order to, again, because at that time it was understandable that if the dollar was too strong, there would be problems for the US, and US are also struggling with growth issues.
And the rest of the world also, because if the kind of US can't print dollars, then the rest of the world can't print their own currencies. So growth is constrained everywhere. So it was...
Plus, 70s were also a period of turbulence in other forms. So the oil
stagflation,
so the oil problems, so the nationalization of oil fields in West Asia, the oil shocks, the two oil shocks of early 70s and late 70s. So there are lots of things that happened. But gist is that the Bretton Woods system broke, and the Triffin Dilemma proved to be correct. Economists in the last, I would say, decade or so has started worrying about the new Triffin Dilemma. That look, the peg to gold is no longer there, but the US dollar is still the reserve currency of the world.
Right.
It still has to incur a current account deficit. It will inevitably be, if it doesn't, then there will be a monetary expansion in the world. So it has to keep incurring current account deficit. And if that is the case, then after a while, its net international investment positions should become so bad that the dollar has to go through a very forcible readjustment, which in a way is what we are now likely to see. So I'm not saying the dollar will have to devalue or that, this is the way things are going to play out, but this is the broad problem that needs to be solved.
And the last problem, Neelkanth, just to kind of clarify a little bit, the last problem is that because the dollar is the reserve currency, all countries need to own dollars. And as an example for India, the way for India to own dollars is to export something to the US. So India exports services and India gets remittances. These are the two main sources of dollar inflow into India. In both cases, these dollars are, when India has dollars, it is owning some US asset. Typically they will, like the RBI, go and buy US treasuries or something. And so what's happening is on the current, if you take a balance sheet P&L view, on the P&L side, there are dollars moving out of the US is buying something from us, and hence they have a kind of a negative flow of dollars to us. Consequently, on the balance sheet side, India is going and investing in the US, so it owns
So when you own those dollar assets,
by definition you're kind of holding some part of the US, and the net investment position that you talk of is the cumulatively how much non-US countries own US assets minus how much US owns non-US country assets.
Exactly. See, it's like, the asset and liability you would do for a company or an individual.
Correct.
That how many assets do you own, how many liabilities you have.
Yes.
And so at a country level, if you just add up all the assets and all the liabilities, so the difference between them is so those assets can be owned by the government, the central banks, individuals, by corporations. Yeah. And the liabilities can also be of the government, of the corporations, of the individuals, or sometimes even the central bank. But the difference between them is for the country, the net international investment.
And as you said, that for the US now is $18 trillion negative, which means that foreigners own $18 trillion more of the US than the US owns of them. It poses two problems. One is the problem that you mentioned, that at some point in time, people are going to say, boss, is the US safe asset at all, because it has so much debts. The second, from a US perspective, is a little bit of a national security thing, because like foreigners own so much of the US.
That they have, you can't again go back and say, you know what, this, I didn't know this was in the So, no. So this is a very deliberate strategy. So you don't just randomly become the reserve currency of the world.
No, of course.
So it takes a lot. So for example, the Fed's creation in 1913-14 was, in the first 10-15 years after that, they enabled many provisions which allowed the US dollar to become the reserve currency, displacing the sterling around in the early 30s. And after the Second World War, there's a fascinating concept of the euro dollar, basically the dollar outside the US market, US economy. Now, why did it form? Why did the euro dollar market form? It was because at the end of the Second World War, where the US had been providing munitions and all of that to so many people, a number of people had dollars. And the US was worried that all of them, if they started demanding gold, they would run out of gold. So what they decided to do was create frameworks such that foreign banks could hold dollars and could lend dollars and basically create a functioning dollar market outside the US. It took a long time for these frameworks to get established, and then a lot of to and fro through Fed governors, through lots of changes globally. So they have deliberately created a system, and finally it has helped everyone.
Yes.
Not to overly blame the US or victimize them. Both are wrong. This is a system which has helped everyone. I think it's reasonable to say that this is a system which at some point was bound to show the kind of problems that are emerging, and we need to solve them.
Yeah, no, absolutely. And I mean, just going back to the previous example, like we've in the past discussed how governments have the ability to print currency, and because they have the ability to print currency, they get seigniorage. The US ability to, by becoming a reserve currency, actually US has seigniorage over the entire world.
Yeah.
Right. And so again, they are just kind of printing some pieces of paper, and they are able to get so much value. So
as we discussed, 80-90% of the $100 printed currency
is outside the US.
Is outside the US.
Yes.
It costs like a few cents to print.
Correct. Great. So Neelkanth, we've spoken at length about the Triffin Dilemma and the Nixon Shock and the like. So just coming back to, so just to summarize, basically three problems. Number one, domestically massive inequality, and a sense that a large part of the population hasn't progressed, as evidenced in the difference in the lifespan that you mentioned. So that is problem number one. Problem number two, because of the reserve currency status, they are gaining a lot of debt, and that's causing obvious challenges. And problem number three, they believe all of this can't be solved multilaterally because there are some bad actors, and that is skewing the entire situation. So now let's come to their actions, and what is the rationale for those actions given this context?
Well, it is now we come to a stage where it's going to be very hard to put logic
But we can try.
So, you need to have a starting point for negotiations.
Yeah.
And clearly, again, reality is that the global trade system or trading system has to be very complex. We're talking about $25 trillion of global trade crossing borders, goods trade that is crossing borders. And there are, some 80, 85 large sectors, thousands of tariff lines, so many countries. And so there are, they're not just import duties. I mean, there are tweaks that people do to local taxation to sort of benefit one over the other. There are non-tariff barriers. So for someone even, there's one writer who says that the biggest non-tariff barrier in the European car industry is that they don't have a speed limit. So the autobahns in Germany, they don't have a speed limit, which means that the cars there need to be extraordinarily safe. And so, and that makes them much more expensive, and the American cars are not designed to be that safe. So that kind of bars them from that market. Now, some people say that Americans didn't want to have a different side of driving, and so that there are much simpler issues to explain that. But so the non-tariff barriers can be really complex. So when you are deciding on how to, and then there are countries that manipulate their currencies. So for example, the Vietnamese dong has been almost pegged to the dollar for a very long time, and despite the fact that from being 1/3 of India's exports, now they're almost equal to India's exports, goods exports. So and they have a $130 billion sort of trade surplus with the US. So, so how do you blend all this in and come up with some starting point for a negotiation? And so, I mean, there are stories that they asked ChatGPT, and that because they had stopped paying for licensed software, they actually used the free version of ChatGPT to come up with this formula. Now, whether that is correct or not,
Yeah.
the point is that this is a starting point for a negotiation.
But we'll come to the tariffs itself. But what does, like, in the context of these three problems, what does this achieve? Like, what are they trying to do?
So they want to, I think first, okay, so there is a problem of the net international investment position, which is negative, for which the solutions can be far more disruptive than what we are seeing today.
Right.
I think they're solving points 1 and 3, and 1 and 3 are somewhat linked, because they want to solve one, and for that you need to break the multilateral order. So, so you need to have a bilateral arrangement. So that creates many complexities, and I'll work through that as well. Now, so the first thing is that you need to have more manufacturing in the US.
Right.
Well, they think they need to have more manufacturing in the US, let's put it that way. Now, in order to achieve that, you need to bring down your manufacturing trade deficit.
Right.
Now, if you have a $1.2 trillion manufacturing trade deficit, if you bridge that, the assumption is that a lot of manufacturing will start happening in the US. Now, how do you go about it? So you can go about it at a sectoral level, you can go about it at a country level. Now, there are pluses and minuses of both. I think they just chose to go with a country level discussion, because then it is easier to have a bilateral discussion. I'm assuming that is the reason. So the whole objective of these tariffs is, and which is why the underlying formula, as I said, people claim it was not even the the ChatGPT plus. That it was the free version of ChatGPT which actually threw out this formula. Apparently, the Commerce Department and the Lutnick, the Secretary, Besant, the Treasury Department, so they all, and some other economic advisors had also put in reasonably complex frameworks, but all of that was junked. And 1 or 2 days before this final announcement, apparently they went ahead and did this. Because anyway, I think their assumption was that this is going to be a negotiation.
Right.
But what is fascinating is that the negotiations prioritize almost a balanced trade with every country.
Right.
Which it's not, you don't need to be an economist to know that is unworkable. It's not a feasible target to work with, which I'm sure as they get into the negotiations, they will also realize, and then they will work around it. And so they'll find, like for example, it is impossible for the US to be able to produce shoes at the kind of costs that we're talking about. The wage cost of a worker on the assembly line for at a shoe factory is about, give or take, $150 to $200. You really think that a country with $85,000 per year of per capita GDP, and so $7,000 on average of per monthly wages, will be able to find people at $200 per month? I think they will also realize that this is not feasible, and neither is it important from a strategic autonomy perspective.
Yep.
See, there are other slightly worrying trends here. I think it may sound premature or scaremongering, but it is important to put everything on the table, because frankly, the government, also several senior government officials, including an advisor to Mr. Trump, has used this phrase, the arsenal of democracy. This phrase was first used in the famous 29 December address by Franklin Roosevelt, where he announced that the US was entering the Second World War, and that the US would be producing 50,000 aeroplanes a year, fighter planes a year. And after 1942, so there was no car manufacturing in the US. So the car factories are all producing armaments. So basically trucks, tanks, and fighter aircraft. So when they put a 25% import duty on cars and say that we need to have an automobile manufacturing industry. And the advisor uses the phrase arsenal of democracy. There's a book by the same name, which documents how this whole thing happened. It shows, and then why would a country with a per capita GDP of $85,000 want to make steel? Or say that, why do you want pharmaceuticals in that too, like generic pharmaceuticals to be manufactured? And someone says, you know what, we can't make penicillin. No, these are all signs that they are talking about being self-sufficient on critical things which are needed in a war, an actual war, not just a trade war. So now I don't know how widespread this belief is in the establishment, but this, at least for some of the current advisors in the central government there, this also seems to be a motivation. So I think the objective is to get manufacturing back into the US. The vice president has talked about how even to do good design, which actually is a service, you need to have some manufacturing skills.
Right.
So the fact that you have no manufacturing means that very quickly you will lose the design skills also. So I think this is these are the sort of multi-layered motivations behind trying to achieve a bilateral trade balance on the manufactured goods side, which I'm sure they will realize is not feasible everywhere, but they do want to reduce that deficit in a meaningful way.
So just to kind of summarize this, hence basically the driving motive is to say that we need to bring manufacturing into the US. The way they are trying to do it is they are putting tariffs, they are trying to make imports more expensive. If imports become more expensive, then local manufacturing becomes more competitive. And if local manufacturing is more competitive, the hope is that people will start manufacturing locally. Conceptually, this is the theory. Having said that, as kind of we discussed earlier, that the moment you put tariffs and your kind of balance of trade moves, what that will do is that there is lesser demand for kind of you're selling lesser dollars and buying lesser rupees or whatever else, which means that the dollar starts to appreciate, which means actually that the price of the import actually falls further, right? So there is a little bit of annually happening there. So that is one thing to consider. But just coming back, by doing this, the hope is that the manufacturing sector revives and A, the incoming inequality drops, and B, they become self-sufficient in these things. Now, Neelkanth, moving to this, like if you were to stay with this thought, let's say that tariffs let's assume that no negotiations are happening and they just kind of go and impose the tariffs. So what happened, like what is the administration's thinking about this kind of playing out? Because as we discussed, like the exchange rates will adjust themselves. And
okay, so this is where the Treasury Secretary explained in an interview I think with Tucker Carlson that if the tariffs are 10%, his estimate was, and I'm sure it varies from sector to sector, but that 4% will be borne by the manufacturer, that is the person exporting to the US, the company. 4% will be currency appreciation, and 2% will be passed on to the consumer. Now, so that was his split. Now, think about
consumer prices go up by 2%.
That was his.
Which means that the American local manufacturing company has a 2% kind of thing to play with. Okay.
So, and which exactly is the right way to think about it, that the price increases in the local market are not an undesirable side effect. They are the intent. They should be the intention. So, unless prices go up, see, why will supply increase? Right. This is like basic economics.
Right.
So prices have to go up. Now, the fact that the currency may not rise by 4% because there are many other factors that affect currency movements can be also, supplemented by the fact that the exporters may not take that 4% hit. See, as per news reports, as some of these buyers have gone to the US, say for apparel or shoes or whatever, toys and several machinery, and they've asked the suppliers to cut prices. I mean, there are theories that Chinese government has told these manufacturers not to do any price cuts. But it could also be that they won't be viable. I mean, they're all of them, as we have discussed often, there's barely any profit margin left there for them anyway.
And in the absence of competition, why would you?
Yeah, then you can say that. But see, the good thing about economics is that, if you keep digging, you'll find some fascinating insights. And I'll come to the insight, but just to complete this argument, I think it's reasonable to expect that there will be quite a bit of price increases in the US. And that should give some type of a price signal for manufacturers to increase production there. The question to ask is, what next? Because if this whole system is so disruptive, and suppose there is a lot of political churn, and it's reasonably clear that Mr. Trump won't be around for the third term, whoever the next leader is, remember that Mr. Trump, even in his speeches 40 years back, was talking about tariffs.
Correct.
So it is quite possible that even if it's the next Republican administration, and the administration does want to get manufacturing back, which I think is a reasonable objective to have for someone trying to reduce income inequality, they may not use tariffs in such a big way. In which case, given that a factory will last at least 15-20 years, will people be willing to invest?
Yep.
Second, US unemployment is 4%.
Right.
And for specific types of manufacturing, you need very skilled employees.
Yeah.
So you need a sustained period of high tariffs for the actual manufacturing shifts to happen. So no one is going to shift a factory for 2 years. And the development of local skill sets, where for 15-20 years you've only seen attrition, will take a very long time and a lot of price increases to create those incentives. Look at steel, for example. I mean, the tariffs have been so high, but has US steel output gone up substantially? So this is, but when it comes to the imposition of tariffs, it is reasonably clear that tariffs hurt everyone. It is a fiscal contraction, meaning that April 2 tariffs, if you looked at, say, the US imports and from various countries, and you applied the country-wise tariff numbers, you've got about a $550 billion. So not just 2nd April, but even the 25% on automobiles, on tariffs on metals, aluminium, which had been imposed earlier, is about a $550 billion number. The revisions that were announced, I think, last night or the night before last, brought down everything else to 10%, but the Chinese was brought up to 125. That actually pushed it up to 600 billion.
Right.
Now, $550 billion is 0.5% of world GDP. It is a fiscal contraction for the world because the US federal government is collecting that revenue. Now, the government says that we will pass it along as a tax break.
Correct.
But one, that will come with a lag. Two, even if it comes, given the uncertainty, it is likely to be saved.
Right.
So it is a fiscal drag. So it actually slows the world economy down. In terms of shifting manufacturing, if it stays that long and people see the resolve that this is not going to change very quickly, or that enough disruption has happened, and that specific pockets of the US economy are now more willing to attract. Remember, it's not very easy to invest in the US. So you need to see a lot of deregulation, a lot of local government involvement in attracting specific types of industry, creating the hubs. I mean, there is this Economist article published yesterday on one journalist who has gone to the shoe manufacturing hubs. So there are markets after markets of companies selling fabrics that shoes are made of, or inner soles that go in. So there are component suppliers, and that whole ecosystem needs to exist for the final assembly to happen. And why shoes are very simple, across the world, across industries, you need that whole ecosystem to get built before the manufacturing starts to shift. So if tariffs are the only change made, this is going to take a very long time.
Right. Understood. Great. So Neelkanth, very helpful to understand this. Let's come to a couple of things that have happened in the recent, which is they made the tariff announcements and then, suddenly they put a 90-day pause to it. So what happened?
So, you see, the fact that the tariffs were much higher than people expected created a lot of uncertainty. The fact that they were not even based on MFN rates. See, on 1st of April or 30th, 31st of March, if you had sat down and looked at who will get hurt most, you would have identified very different countries than what eventually happened. The formula used was very different. And uncertainty is something that the markets hate. In particular, as it started to become clear that the ultimate victim was going to be China, because see, when you see the big trading partners of the US, so there are 12 of them which account for 85% of imports in the US. So 9 of them immediately said we are willing to negotiate. So Vietnam, India, South Korea, all of them said, Taiwan, they all said we are very happy to negotiate. 3 countries tried to oppose this or challenge this, or say country/region. So European Union, Canada and China. Now Europe also over time aligned. Canada maybe after elections in May will align. So the only country left is China. So you began to realize that China was going to be the biggest disruptor. The Chinese balance of payments is already under pressure. There are several other economies where, because of the uncertainty and the fact that, say, so for example, even for Vietnam, the fact that there is suddenly a 49% duty, and this country has a $130 billion surplus with the US. And if the US is going to target the bilateral surplus and not anything else, and it is quite possible, given that the Vietnamese dong has been unduly and naturally stable against the dollar, very clearly the US is going to investigate them for currency manipulation as well. In which case, some of these currencies come under attack. So then what happens is that the central bank starts selling what they have to protect the currency from undue volatility. And so suddenly the US treasuries, which is what are held as reserve assets by most central banks, start to see yields go up. Then something happens which is completely unrelated to anything we've discussed so far, which is the basis trade.
Yep.
So in the US, a very large part of bond buying in the last 15 years, and in particular in the last 3-4 years, has been through hedge funds. So what these hedge funds do, see what happened after the 2008-9 crisis was that the large banks were told to reduce leverage and not become market makers or take too much risk in the bond trading markets. So then the liquidity started to fall. This is where the hedge funds came in. Now, the hedge funds would buy the treasury, buy the bond, and sell its future. Now, there's a thin spread between them, and they would take advantage of that spread. But it was too narrow a spread, because these are both liquid markets, for them to make a lot of money. So they would lever up. And for some reason, the bank treasuries, the large bank treasuries, were allowed to provide that leverage to these hedge funds. Some of them would be 100x leveraged. So as you can imagine, even if there is a 1% drop in price, that story gets over very quickly. Now, when because of this undue selling by central banks to protect their currencies, and including from China, the futures prices don't change because they are selling. See, this is a liquidity hunt. And around the same time, because of the elevated uncertainty because of global trade, global prices, global growth and all of that, all bank treasury folks were told, bring down your leverage. So now the banks are telling the hedge funds, dude, we gave you 100x leverage or 60x leverage, but please wind down, give me back the money.
And margin calls are also happening.
Margin calls will start happening now. So suddenly, all of these large hedge funds, which were at 60, 100 times leveraged, are unwinding positions. So there is an excessive supply of bonds and there is no taker. And this is happening around the same time that some central banks are selling as well, which of course is smaller in number compared to the basis trade itself, in terms of the volume that is coming to the market. And this kind of feeds on itself, and suddenly, at a time when you would have expected that bond yields should be falling,
Yep.
The bond yields are starting to go up, and sovereign bond yields that is. Because normally what happens is that at a time of growth uncertainty, people sell equities and push money into bonds.
Yep.
And the expectation also is that over time the Fed will cut rates, so the bond yields will fall, which means they will rise in value. So it's a natural trade to do. Very oddly, the bond prices,
effect.
yeah. So the stock prices are falling, and bond yields are going up.
Yeah.
2020 March, when something similar had happened, that when banks, in order to get liquidity, because of the uncertainty, had started selling treasuries, and that triggered margin calls and unwinding of the basis trade by hedge funds, the Fed had to buy $1 trillion of treasuries in a month.
Yep.
So just to provide that other side to sort of force the panic to subside. So now this means that, see, so far, while the yields have gone up a lot, it has been still orderly. So we haven't heard of, there have been some rumors on social media, but we haven't heard of large failures.
Any actual failures, yes.
So but if this was left unchecked, if this is left unchecked, failures will happen. Now, as one of the bloggers wrote, that this may be the only financial system failure attributed to a person. Because the 2008-9 crisis was a build-up that happened over 4-5 years, greed of the banks and all that. 2020 was, of course, COVID. No one can be blamed for that, at least not the US government. And in this case, it is only one person who could be held responsible for it. So while the chaos that ensued after 2nd April, and remember that, see, the US is also a democracy. So there are congressmen, there are congresswomen, there are senators, there are friends of the Treasury Secretary, the Commerce Secretary, and remember, both of them come from financial markets.
Yes.
So there are enough channels which are communicating how chaotic this is and how disruptive it can be. And so from what some of the newspapers have written about the flow of events, apparently Treasury Secretary took a flight with President on Air Force One, tried to explain to him that it was uncertainty which was very disruptive, and that it has been a shock to the market, and therefore we should just we should still go for the tariffs because the president is convinced about them, but we should give a leeway. But apparently till then the president was not convinced. It is only when the bond yields kept going up, spiking, that finally said, okay, you know what, let's.
It's a very interesting episode, Neelkanth, just to clarify some of these things. So number one, this basis trade, basically the theory, what's happening is that hedge funds are buying the bond, selling the future on the same bond. The bond is a cash instrument, meaning that you have to, if it's $100 bond, you have to pay $100 to get the bond. The future is you only pay the margin. So it's kind of less expensive to trade. And because it is less expensive to trade, there is a little bit of a premium there because lots of people are trading. And so the hedge funds are trying to kind of arbitrage this premium. So they're saying, I buy the bond, I sell the future. My risk is zero because it's the same instrument. If this goes up, that goes up. If this goes down, that goes down. So I am hedged on risk on both sides. But whatever small basis points premium is left, it's a profit for me.
Correct.
Because that basis point profit is small, to make sense of this, they have to leverage.
Yes.
So what they're doing is actually when they're buying $100 of bonds, they are putting 1 rupee of their money and 99 rupees or $1 of their money and $99 they are borrowing from some bank. And the bank is saying, look, the collateral is a bond. So frankly, I'm fine because it's a US Treasury. That's the safest asset in the world. So I'm fine to leverage. So the bank has given, I'm the hedge fund, bank has given me $99. I put one of mine, bought the bond, sold the future. This trade has worked beautifully for me. And so I'm continuing to do it. I am now leveraged 99x in this case, but let's say 100k, 100x. Now what has happened is that the tariff announcements have been made and now central banks start selling. when people start selling bonds, the bond price falls because there is more supply and less demand. And when bond price falls, the yield goes up.
But the same is not happening in the future.
The same is not happening in the future, and because this is a liquidity event, it's not a.
Yes.
This is not like some macroeconomic thing has changed. It is just suddenly people are coming and dumping. So suddenly you see the yield on this jump. The yield on the future hasn't, which means that the basis trade,
Yes.
from being a positive trade, it has become a negative trade. So I am 100x levered, which means I am taking 100x the loss.
Yes.
Right? Earlier I was taking 100x the profit. Now I am taking 100x the loss. When I am taking 100x the loss, the bank is getting worried. Plus the bank is anyway worried because of whatever is happening. So the bank is then, asking me to pay back them, if not the entire 99, at least the 50. For me to pay back the 50 to the bank, I have to sell. So basically there is a fire, and now I am putting petrol on the fire because I am also selling.
Yes.
So I am selling, and you are another hedge fund, you are also selling, and everybody is selling. In a market in which everybody is selling and there is no buyer, the prices will just move in one direction, and that's what happened actually. And it was very counterintuitive because everybody would have expected that the bond yields would have fallen because people would sell stocks, buy treasuries, and in the case of uncertainty, anyway everybody moves to safe assets, and the safest asset in the world is the treasury. So the yield should have fallen. It went the other way around, and the reason folks have become nervous is that if this goes like a failure of the bond market is catastrophic, it'll just kind of have many repercussions, and that's what seems to have spooked them. So I mean, it's not fully relevant to our conversation, but a very interesting episode that has happened.
But it tells you how interconnected markets are.
Yeah, absolutely.
And that when you make dramatic shifts, there are political limits. We've discussed the Overton window, right? The breadth of policy making options that are available to a government. So you may think that president or a prime minister is free to do what they want, but actually it has to be acceptable to a large number of people, otherwise it won't happen.
Right.
Even though you are legally elected and you are very powerful. What this shows is that sometimes the side effects, the financial market side effects of your policies can also force you to backtrack. That it need not just be a political consensus. In this case, the feedback did not come from the bottom 50% that they are targeting and they are messaging to, that we are doing all of this for you.
Right.
It actually came from the financial markets.
Right.
And then they were forced to sort of put a stop to it. So it shows that no one can fight the bond market, which has always been true. But also that I think pushing through with this level of uncertainty can create sort of unexpected risks.
Yeah, and second, third order effects which you cannot anticipate. Now, Neelkanth, moving on to the capital market side, like the capital account side of this. So tariffs, we spoke about what happens and so on and so forth. So there are two questions, Neelkanth, on the capital account side. First is this problem number 2 exists, which is the net investment position. So what could be ways of solving that? Obviously, if the trade starts to balance, it automatically reduces some of it, but already it is quite large, right? So incrementally it will not. So that's kind of one. The second is all of this seems to, kind of, if you look, you mentioned this, which is if you look at the Scott Bessent himself mentioned, which is 88% of the US stock market is owned by the top 10%. The next 40 own the other 12%, and the last 50 don't own anything at all. And there almost seems to be an indication that they are trying to move money from here to there. Like there's a reverse this thing. So what does that mean for, global markets, stock markets, equity market, dollar market, and so on and so forth? Let's start with the first one.
Yeah. So, see, I don't think changing trade flows will very quickly improve the net international investment position.
Right.
So I'm going to have. Some of it is automatically happening in the sense that because of this stated intent, which is part of your second question, that we want to reduce the imbalance in the capital and labor share of income in the US. So basically, profit growth in the US has grown at a remarkably fast pace, faster than nominal GDP, much faster than nominal GDP, and therefore it needs to be brought down. If you force a lot of manufacturing into the US, so suppose you actually put a 27% duty on average, and a lot of manufacturing comes into the US, and given that there's no unemployment and they've clamped down on immigration, so the same workers will find a stronger bid. Now, it'll make inflation a lot stickier, but it can, over a period of time, force people to manufacture with much higher wages, and therefore the capital labor share starts to come down. This is not how it has been explained by anyone in the administration, but this is one way in which it can work out. Now, given that the US is the epicenter of the uncertainty, and now there are fears and speculation that the US could actually put a tax, withholding tax on holding US dollar assets. And remember that in the run-up to this, US stock market was nearly 70% of world stock market capitalization. And if you see foreign holdings of US equities were at a record high 18%. 30% of, nearly 30% of US treasuries are held by foreigners. So when you combine all of this and the fact that you must have seen the trade weighted dollar is now below 100. So again, in the normal panic, the US dollar would appreciate because people would seek safety in the dollar. Currently, everyone seems to be selling dollar assets because the epicenter of this problem right now is the US economy and the US financial markets. So if you think as an investor that the profit to GDP in the US has gone to an incredibly high level, and it is now it's a political imperative to bring it down, which means that profit growth is going to be slower than nominal GDP growth, and therefore it makes sense to sell what were anyway overpriced US equities. So that's point one. So people are already selling those equities, and therefore in a way, if you see it this way, the net international investment position is already shrunk by $1 trillion.
Right.
I mean, so if you do the broad math, say the US stock market cap was say 60 trillion, I forget exactly how much, but broadly in that range. And it has corrected by, say, 10%, or say 12, 15, 20%, 15, 20%, say 20%. So that's like 12 trillion. And 18% was owned by, so there's nearly a 2 trillion drop in foreign holdings. So international liabilities have actually that way come off. So that's one way of doing it. You kind of devalue your own sort of financial assets. What can happen, and I'm seeing these kind of estimates now in the blogosphere, which doesn't mean that they are going to get implemented, but the fact that the yen is too cheap, that at 140, 143 it is too cheap, and that maybe a 20% stronger yen is the necessity. I won't be surprised if, say, the Vietnamese dong is forced to appreciate, because there's no other way. So if you are, say, Vietnam and you are negotiating with the US, however irrational it may be to have zero bilateral trade deficits, suppose that is the starting point of the negotiation, because in any case, it makes the US much stronger. So they'll keep insisting on it. Maybe you allow some military bases to get created in Vietnam, or sell them more aircraft or whatever. But frankly, beyond a certain level of purchases, the Vietnamese economy is not that large. The only thing they will have to settle for is a currency appreciation. So the moment the dollar itself gets devalued, see, think about it this way: the foreign assets that the US has rise in value because those currencies are appreciating, and the dollar itself, though perhaps some weakness, some falls, but even if it stays the same, the gap narrows. You see what I'm saying? So in dollar terms, your assets have been marked. So at 18 trillion becomes say 9 or 10 trillion, and then suddenly we have reset. And so it may not need an explicit reset, but with some countries maybe they will go for an explicit reset. But anyway, so the fact that the DXY is at 100 and still falling, and say without any intervention it was fall to 90, so then that argument is well served.
Right.
So These are the kind of changes that they would like to bring about.
Right. But Neelkanth, how do you square the DXY falling in a sustained basis? Because right now it is because of the kind of selling of treasury holdings. But if the trade balance does shift, if the tariff to come into place, actually the US dollar should appreciate. So
see, you're looking at the current account.
Yeah.
Also look at the capital account.
Yes.
Now, see, all the things that we worried about, that and this is why financial markets move in strange ways. So we've been talking about the excessive debt to GDP in the US, sovereign debt to GDP, the fact that the US government has been very profligate, that there is no way they can sustain the debt to GDP without any financial repression, which is going to be terrible for any bondholder. And yet, the world kept buying US treasuries. And as I said, 29% of US treasuries are owned by foreigners. Over the past decade, foreign buying, so till 2013-14, most of the foreign buying was actually done by what are called official sources. So basically central banks.
Yeah.
The central bank buying has been actually flat to down.
Right.
Most of the buying in the last 3-4 years have been actually private investors, meaning insurance funds, pension funds, and even individuals. I mean, so US dollar assets, treasuries at 4.5% was no-brainer. So they've been doing that. Now, if there is a fear that the US may put a withholding tax,
Right.
if there is a fear that the US could force a debt restructuring. So if you see the document called the Mar-a-Lago Accord,
I'll come to the Mar-a-Lago Accord in a minute.
but the fact that you're going to force a restructuring of US Treasury holding by big holders means that those assets become less attractive.
Yep.
That actually puts the US internal balances in a much more severe stress, because in the last 2 years, a very large part of incremental buying of US treasuries, when the fiscal deficit was so high, was from foreigners and from hedge funds. Now, the hedge funds are deleveraging. You can say it is temporary, though finally this kind of leverage is very hard to rebuild very quickly. And the foreigners are not going to step in. So who's going to buy the treasuries?
Right.
And then what happens to 10-year bond yields? And if the 10-year bond yields keep spiking, the US debt becomes absolutely unsustainable. So it's not going to be a zero cost option for the US. So their expectation that the bond yields will keep falling, and that the US dollar will also keep weakening, and that the trade deficit will get sorted out. So there are lots
all
of
simultaneously cannot happen.
Cannot happen.
Yeah. Now, since you mentioned it, Neelkanth, just very helpful to understand both the Plaza Accord and the Mar-a-Lago Accord.
The Plaza Accord was only against Japan, more or less. That they realized that the deficit with Japan was very, very large, and of course they had a unique leverage over Japan, which is that there is still an army base, and America was a very critical part of the rebuilding of Japan after the Second World War. So they could force them to do it, and Japan had a great dependency on the US, so they had to do it. Now, Mar-a-Lago Accord,
just on that, so basically in the Plaza Accord, Japan and US sat together at the Plaza Hotel, and basically they said that the Japan will adjust their currency
by 40%,
so that the trade balance looks better. So that was the Plaza Accord, and then Japan went and kind of executed whatever was asked for.
Correct. So the Mar-a-Lago Accord is the reverse of that. I mean, so basically, that the ask is that, or see, there's no accord.
Yeah, the Plaza Accord is in the past. Yeah. The Mar-a-Lago Accord is prospectively in the future.
Yeah, that's what they would like to see.
Right.
And there are some documents, and sometimes, from a posturing perspective, these documents kind of start setting expectations. So what they are offering is effectively like a debt restructuring.
Right.
That if you want the American security umbrella, so clearly this is not going to affect, say, India or China or some other countries, large holders. But if you are a Korea, if you are a Japan, if you are a Saudi Arabia, Europe, if you are holders of US treasuries, you will be asked to swap them for perpetuals or 100-year.
100 year, yeah.
That and so in effect, so you'll stop getting any coupons, and the fact that this restructuring happens, you may actually lose value. So effectively, if you want the security umbrella, this is how you pay for it. Now, so it's this itself. Now, you would think that it only affects, say, few of these countries which actually depend on the US,
right,
for their physical protection. But if the underlying assets are the same, so if say you are Japan and you see this coming, you will stop buying those treasuries again, and at the margin you may want to sell some of those, and that actually then pushes up yields and that hurts everyone. So it kind of you cannot have a selective default. You may be stating it as a selective default, but it's actually because these are liquid markets and they get priced very quickly. So it's going to be very hard to execute something like that. Frankly, the first time I read it, I said, "What are they saying?" Right?
So just to kind of summarize this, so Mar-a-Lago Accord is it's a hypothetical construct where the fundamental belief or the fundamental kind of thought is that the US has a large deficit, which is obviously bought in by all these countries. They are saying, I mean, this is again Scott Besant's philosophy of splitting countries into three buckets. There is the green bucket, which is people who are explicitly using the US security umbrella. There's the neutral bucket, which is countries like us. We don't have any security, this thing from the US, but we are also allies. We are not enemies of the US. And then there is the third bucket, which is the red bucket, which is let's say China is there, right? Which is basically enemies. And they are saying that, so they are trying to bring their security and economic policy together. And they are saying, look, because we are reserve currency, we have lots of costs and we are providing security, and so we have even more costs. And we would like these costs to be distributed amongst everybody. Why should only US bear the cost? And the way they are trying to do this is they are going to these friendly countries and saying, or whoever they are providing the security umbrella, and they are telling them that, or they want to tell them that if you want our security, please swap our holdings of US dollar, US treasuries into 100-year treasuries, which are perpetual, which means I will not pay you any interest for the 100 years. It will come to you at the end of the 100th year. And while it's not explicitly said, very likely there will be a yield that is already set. It's not a market-driven yield. So we offer you a yield, let's say that is 2.5% or 3% or whatever, which is much better than the 4.5% that they are paying now. And it takes away all uncertainty for
much
the
better
US.
For the US.
Obviously for the US. And it takes off any uncertainty, right? Like today, 3 years back, US was paying 0% on bonds that they issued. Today they are paying 4.5%. Here it's a nice, for the next 100 years, they have a, let's say 2.5%, 3%. So it is cheaper for the US. Their costs of financing the debt goes down. And by doing that, they are spreading the, cost of providing security to all these countries.
So this is very good in theory.
Yeah.
The practicality of this as to what kind of assets will be eligible for this restructuring, or will be swapped, and will there be a lock-in?
Are those tradable?
And will they suddenly announce it? Because see, the whole point is, if you suggest this is going to happen,
they'll sell, like, how will you hold it? You will sell it, right?
So you have to just one fine day go and tell them, like what Nixon did. Yes, from tomorrow, no gold backing.
Correct.
Or no, from now, no gold backing.
Correct.
So something like that has to happen. So
correct.
I think it is, well, even what has all has happened, very hard to say it is far-fetched, but this level of default is again, I think, to some extent, the debt to GDP is so bad in the US, the sovereign debt to GDP, that a one-shot reduction will definitely give them a lot of room. The bigger issue is, after something like this, what really is a safe asset in the world?
absolutely. So the second order impact, which is not mentioned anywhere, is that you do this because you are the, kind of don in the house. So you kind of make the swap happen. You make an offer that people can't refuse. But then what happens the day after tomorrow? And what happens to the normal bond that you will anyway continue to issue, right? Like you need to finance your deficit. So then who are the buyers for that, and what happens to that, to the international market, is a big question. And this actually is a far more disruptive.
Yes. So we haven't got there. So which is why I think trade is something that I think the president has been talking about, as I said, for 30, 40 years. So this sort of got out to the blocks first. But this level of disruption, frankly, if the market continues to be choppy, and I think it is reasonable to expect that it will still be choppy, the disruption that can come from a change like this can be much more volatile, because suddenly a lot of set assumptions will have to be revised. What is the risk-free asset? And underneath all this, I think what we are forgetting is that this uncertainty is terrible for world growth. One very basic rule of thumb I use is that if, say, corporate capex is 8 to 10% of world GDP, which I think is a reasonable number to work with, and say even 10 to 12% of that gets pushed out, that it is in some ways linked to global investments or globally integrated sectors, that's 1% of GDP.
Right.
On top of the 0.5% of GDP, which is the fiscal contraction because of the tariffs, the fiscal impact of the tariffs. Now, a 1.5% growth headwind, when the world was supposed to grow at 3.2%, is like a 50% shaving of growth. And it is very unlikely that this uncertainty is going away in a hurry. So this creates, I think, very significant growth risks already. Those kind of policies, given what we've just seen in the bond markets and the volatility, so there is a certain appetite at which the economy and the markets can take change. And we may be stretching that limit.
Right. And the tariff impact is it's kind of it's a trade impact, it's a P&L impact, it's a revenue impact. The bond market, the kind of financial assets impact is a balance sheet impact. It's actually a wealth impact. And then the confidence around it and, trust and how financial systems work, those outcomes are just completely unknown, right? They are completely
Yes.
And they can be many multifolds of what tariff could do, and it's not reversible. Tariffs are even kind of, you can put a 90-day pause and so on and so forth. This once you kind of default, you've done it, right? And
correct.
Then people have questions about what to do. So anyway, so that's a little scary outcome which hopefully we don't get to, and better census prevails. Now there are two other directions I want to take this conversation to, Neelkanth. One is around, like, there is a real problem. It's not like there is no problem, right? So whatever is being done, it's not some, it's not something that somebody has just woken up one day and said, no, now I'll do this. There is a real problem. So one direction to go to that will be helpful is what could be a way to resolve that problem. The second question is, in the context of this, what are the implications for the world and for us?
So, as we discussed earlier, that the key entity here is China.
Right.
So there are imbalances with Japan, with Europe, with Australia, with India, but the big sort of elephant in the room, the enemy number one is China. Now, so at some point, I think China and the US will come to the negotiation table. At this stage, the very fact that they are still imposing duties every other hour suggests that they are now realizing that numbers are now meaningless. So you can put another 20% if you want. Anyway, so So beyond a point, I think the costs of the disruption will be so bad for China that they will, through backdoor channels or whatever, come to some agreement. Bad case outcome could be that this results into some other distraction, and actually not just a trade war, but an actual war.
Yeah.
Hopefully we don't go there. So the only way out of this, in my view, is, see, one, of course, there is going to be, and to address part of your second question, the fact that India is far ahead of most of the countries in terms of the bilateral trade agreement negotiation with the US. And it is blessed by senior leadership on both sides. The chances of India potentially gaining share as the attempt is to sideline China. So remember that even if they cut a deal with China, the fact that they're going to reduce dependency to China. And even in this interim period, see, I was reading that starting November, even apparel and shoe buyers in the US had stopped giving orders to Chinese firms, and they were actually scouting around in India. So if we can use this opportunity to actually sign a good deal, which has a reasonable amount of tech transfer, which has a reasonable amount of trade benefits, the ability for India, say over the next 3 to 5 years, to go from 2% market share of global goods exports to 3% market share is a meaningful one. So if we play our cards well, I think on electronics, on apparel and footwear, just these three, there can be significant gains that can be made. So basically, $200 to $50 billion of additional goods exports can come our way. Now, in terms of settlement, I am reasonably sure that the tariff rates, even after the dust settles, will be substantially higher than what we are now at. And that is primarily due to the fact that many people in the Trump administration also think of import tariffs as a source of revenue.
Right.
So between 1866 and 1913, 50% of US federal revenues. So this is post the Civil War and before the First World War. Remember that income tax was introduced around the Civil War, but then withdrawn once the Civil War ended, and then reintroduced around 1914-15 at 1% level. So the income tax was almost non-existent. So the US federal government used to fund itself with tobacco taxes, and if you read some of the Treasury Department documents at that time, there is a whole list of types of cigars on which, what type of duties collected and all of that. So 50% used to be import duties. A large number of people in the current Trump administration are obsessed with that era where the US kind of kept to itself, let the Europeans fight their own battles, do their own stuff. They, in their splendid isolation in the Pacific and the Atlantic, they focused on their own economy and did their own thing. And so, if you want to access our markets, pay the hafta, pay the tariff. Now, so they want to generate revenues out of this. So whatever happens, I think we should assume that tariffs will be much higher. So if the US collected $79 billion in import duties in the last fiscal year, that number, it is reasonable to expect, will be $300-400 billion when this dust settles. So it is not going to fall back to $80 billion. The second is that this is all directed towards China, and we need to have an agreement between these two countries for the rest of the world to be able to function. Otherwise, remember that if you plot the volume of goods exports over the last decade and the volume of goods imports over the last decade, you get separate data sets from everywhere. The only country effectively where there's been a growth in exports has been China, and the only country where there's been a growth of imports has been the US. So if these two countries are disrupting trade, I think it's going to be very, very damaging, because we haven't seen the second, third order effects yet.
Right.
So when multilateralism gets over, all types of industrial policies become fair game. See, the reason why export subsidies were not used for the last 15-20 years explicitly by countries because they were afraid of the WTO. Now there's no WTO. So it'll create massive amount of chaos if the Chinese give in. So far they're working hard to protect the currency from very sharp depreciation. If they let the currency slip by 10%, every other currency will have to start falling, and that will create a different level of economic uncertainty. So it is not just about that this is the worst point and that how do we backtrack from this. My fear is that this can actually get a lot worse before everyone says, oh God, this is too much pain. See, at this stage, there are some people who are saying that the theory in the US being followed is that, look, this is going to hurt me. We're going to hurt you a lot more. This is the classic, there was a column today by Jerry Rao in the print where he talks about the marginal welfare losses will be much worse in a Bangladesh and Vietnam and China than the possible US. Because, US, large part of consumption is services.
Right.
Goods are a small part of our consumption. And there, if you bring down oil prices at the pump are weakening. So they will lose, but they will lose a lot less. But say a Bangladesh or a Vietnam or a China would lose a lot more. And that's where I think things can actually get a lot worse before people start saying that, you know what, it's in no one's interest. Let's sit across a table and start negotiating. That phase will also come, but we are not there yet. In terms of implications for India, when I said that we are far more domestically focused, so US exports are only 2% of India GDP. The total tariff impact was going to be $10.4 billion when the first round, 2nd April thing happened. With the 90-day suspension, it falls to $4 billion. In our estimate, about 60% of that will be passed on to the US consumer. So if it was 10 billion, it will be 4 billion. If it was 4, it will be 2.4. 1.6. So this is like insignificant. I think the bigger impact for India will be how fast we can participate in the shift of production on sectors where we have capabilities. Electronics, apparel, footwear, how fast can we become part of global value chains in some of these critical sectors. And of course, I think we need to be focused on our domestic markets, keep liquidity easy as it is right now, keep execution tight, so not slip up on the fiscal side. We drove our slowdown last year. So if you manage all of that, I think the growth impact on India on a relative basis should be a lot lower.
Fantastic. Great, Neelkanth. Thanks a lot for this conversation. Very fascinating topic.
It is.
And one that actually is yet to fully play out. So I'm sure we will have subsequent conversations on the same topic again. Just to kind of synthesize whatever we discussed, the starting point for this is 3 problems. First is the problem of inequality domestically in the US. The second problem is is kind of the balance sheet position and the negative net investment position that the US has of $18 trillion, which obviously creates its own second order impacts. And the third is just the belief that multilateral systems are not working, and that entire system needs to be reshaped. And to do that, the reason why they are going down the tariff route is because the belief is that the moment they apply the tariffs, the imports become more expensive, and hence domestic manufacturing gets a boost. Domestic manufacturing gets a boost means that the working class population gets better incomes. And as you said, the share of value added which goes to labor versus capital changes materially, and more of it goes to labor and less of it goes to capital. And so that brings the inequality kind of back into some kind of balance. Now this is the belief, but there are many contradictions in how this could play out. So it may not entirely play out in that fashion. We also discussed how this has played out as of now. And one of the things we discussed is like what happened, the impact of this on the bond market, and how bond market seem to be going out of control, and which is where they've come in and put this 90-day pause. We also discussed the impact, the second problem. The second problem doesn't get solved by solving the trade problem. It's a separate problem. And the solutions or the articulated solutions that are going around. This is not the formal policy. This is not a formal statement, but this is what you hear is the Mar-a-Lago Accord type of a thing, where the intent could be to restructure US debt and bring it down. That could be catastrophic actually for the global financial markets and the global economy. But also the other point you made is that this could naturally correct, at least to a certain extent, which is if if kind of the US financial assets value falls, like the stock market falls, let's say materially, it's already down by 15%, but let's say if it goes down by 30-40%, and at the same time, if foreigners are selling US treasuries and the exchange rate also changes, that means foreign assets become more valuable, and the net investment position, kind of suddenly starts to look very different. So that could be another resolution to this problem. But then this entire part, how it plays out, is yet to be seen. It is a problem they are explicitly trying to grapple with and solve. And the third thing we discussed is the impact on kind of the world and also in India. Number one, this is a very significant, fiscal consolidation. And added to that, the fact that, there is another 1% you believe this will result in contraction because of trade reduction.
No. The postponed investments.
So, so basically 50 basis points of reduction because of fiscal consolidation and another 1% because of postponed investments and uncertainty, which is basically taking the global growth rate down by half, from 3.5% to whatever, 1.5%. And so we are looking at a significant slowdown of the global economy, not a marginal slowdown, a very significant slowdown of the global economy. Unless, of course, the situation somehow magically resolves and, kind of we get to bilateral, negotiations and the like. But very likely a significant slowdown. For India, obviously, India will also face headwinds and, growth will be slower, etc. But there is a silver lining, which is that there is now this China plus one is real, right? It is not just, it's not just a talked about topic. Now there is real economic rationale for China plus one, given the amount of tariffs that have been imposed. And if we get our act right, a lot of that can move to us, because actually the tariffs on us are not that high. And secondly, we are very close to reaching a bilateral kind of an agreement with the US. We need to get our act right and we need to kind of pounce on the opportunity, and then we will still slow, but we hopefully will be much better off than most of the folks. And at some point in time, the global economy will come back. Once we will kind of absorb the shocks and come back, and at that point in time, we can be, far better off. So those are my big takeaways. Fascinating conversation, Neelkanth. Thanks a lot for taking off time.
Thank you, sir.
And look forward to the next conversation on the same.
Absolutely. There'll be a lot to talk about. Thank you.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.